Let me be completely honest with you. Right now, Bitcoin and the biggest financial institutions in the world are playing a game you can't afford to ignore. What happens when the world's most powerful asset collides with the world's most powerful money at exactly the wrong moment? You get exactly what we're seeing today. October 2025. Bitcoin hits $126,000. Everyone's celebrating. Headlines are screaming, new paradigm. Institutions are rushing in like it's the end of the old world. Fast forward 4 months, $60,000, 45% gone. Just erased. And today? February 15th. Bitcoin sits at $69,600. Markets are quiet. It's Sunday. On the surface, it looks calm. But underneath, a war is raging. A war between fear and opportunity, between retail and institutions, between old money and new. What I'm about to show you isn't just analysis. It's the full blueprint of what happened, why it happened, and exactly what comes next. If you pay attention, you'll see opportunities almost no one else will. Let me take you inside. Right now, Bitcoin's flat, trading between 69,200 and 71,000, barely moving, and there's a reason for that. It's Sunday. US spot ETF markets completely shut down. The big money, BlackRock, Fidelity, institutional players moving billions, they're not even at their desks. The only action you're seeing is crypto-native exchanges and derivatives platforms. Thin volume, light liquidity. Tomorrow's a US holiday, Washington's birthday. So Monday stays quiet too, which means the real test doesn't start until Tuesday, February 17th. That's when institutional money comes back online. That's when we'll see if this foundation holds or cracks wide open. Look at the numbers with me for a second. Last 24 hours, down just 0.14%. Looks stable, right? But pull back the lens, down 27%, over 30 days, down 45% from the all-time high, up only 16% from that brutal crash low of 60,062 we saw on February 5th. Now here's what most analysts won't tell you. This wasn't random. This wasn't crypto being crypto. This was 5 separate triggers, 5 catastrophic events, hitting Bitcoin at the exact same time. And when you understand each trigger, you start to see the pattern. You start to see what happens next. Let me walk you through the perfect storm. 5 triggers, 5 dominoes falling in sequence, each one powerful enough on its own, together, devastating. January 27th, President Trump nominates Kevin Warsh as the next Federal Reserve Chair, replacing Jerome Powell in May. The market reaction was instant, brutal, unforgiving. 72 hours. Bitcoin drops from $97,000 to $81,000, 17%. $800 billion evaporates from the entire crypto market cap. Gold drops 9%. Silver collapses 26%. The dollar surges to multi-year highs. But here's what you need to understand. Who is Kevin Warsh? He was a Federal Reserve governor during the 2008 crisis. While everyone else was screaming for money printing, for quantitative easing to save the system, Warsh stood alone. Even as Lehman Brothers collapsed, even as the financial world was burning, he said this: "I'm still not ready to relinquish my concerns on inflation." Think about that for a second. The world's ending. Banks are failing. And this guy's worried about inflation. He's a hawk, a true believer in tight money. And hawks don't like risk assets. What does Warsh want? Higher real interest rates. Sustained, not temporary. Aggressive balance sheet reduction, shrinking the Fed's $6.6 trillion holdings, quantitative tightening, the complete opposite of money printing. Now think about Bitcoin's entire story. The whole narrative that took it from nothing to 126,000. What was it built on? Protection from money printing, protection from currency debasement, a hedge against endless liquidity. Warsh just killed that trade. And here's the twist. Trump picked him partly because Warsh's wife comes from the Estee Lauder family, a personal connection. Some smart analysts think Warsh might actually cut rates under Trump's pressure once he's in power. But right now, nobody knows. And markets don't trade on certainty. They trade on fear of uncertainty. $6 billion fled Bitcoin ETFs. Between November 2025 and February 2026, US spot Bitcoin ETFs saw $6.18 billion walk out the door, the longest, worst redemption streak since these funds launched. Let me give you the damage report. Week ending January 23rd, negative $1.33 billion, worst week since February 2025. January 30th, the day Warsh was announced, negative $1 billion, single session. February 4th and 5th, during the crash, negative $544 million and negative $434 million. Then, February 6th. Something changed. Institutions started buying again. BlackRock's IBIT fund alone pulled in $231 million, largest single-day inflow in weeks. But days later, February 12th, outflows resumed, negative $410 million. Every single fund bleeding capital. Now here's why this matters more than most people realize. This created a feedback loop, a death spiral. Investors panic. They redeem their ETF shares. Fund sponsors like BlackRock and Fidelity have to sell actual Bitcoin on the spot market to cover those redemptions. That selling pushes the price lower. Lower prices trigger margin calls. Margin calls force more selling. More selling triggers more redemptions. And the cycle feeds itself. IBIT, the biggest Bitcoin holder in the ETF space, became the biggest source of incremental supply during the crash. That's not a coincidence. That's structural pressure destroying price action. Let me pause here for a second. What I'm sharing with you right now, this is analysis, this is data, this is interpretation, but it is not financial advice. Your decisions, your capital, your risk, that's entirely yours to manage. Always, always do your own research before taking any action. Make decisions based on your own risk tolerance, not someone else's analysis. The AI bubble started leaking. Bitcoin now trades with a 93% correlation to the Nasdaq. When tech stocks fall, Bitcoin falls almost in lockstep. Why? Because they're sitting in the same portfolios, managed by the same institutions, treated as the same risk category. Early February, something cracked in the AI trade. Amazon announced $200 billion in capital expenditures for 2026. Investors didn't see growth, they saw margin compression. The S&P 500 software index shed roughly $1 trillion in market value. Single session. Then Anthropic announced software that could replace entire categories of specialty apps. Competitive fears spread like wildfire. Hedge funds got margin calls. And Bitcoin? It was the most liquid asset they could sell. CNBC said it perfectly. Bitcoin has largely traded in the same direction as risk-on assets, not as a safe haven. That correlation is Bitcoin's double-edged sword. High risk appetite, Bitcoin soars. Fear takes over, Bitcoin falls harder than almost anything else. $2 billion in forced liquidations. Leverage amplifies everything. Gains and destruction. Over $2 billion in long and short positions were liquidated during the crash week. The war shock alone liquidated $2.5 billion in leveraged long positions. 72 hours. Here's how the cascade works. Bitcoin's price hits certain levels. Exchanges automatically force sell your position to protect themselves. In thin liquidity, those forced sales push the price down faster. That triggers more liquidations at lower levels. Self-reinforcing cycle. Doesn't stop until all the excess leverage is flushed out. By February 6th, 580,000 retail traders had been liquidated. $25 billion gone. That's not institutional money. That's retail. That's people who believed they could time the market with leverage, who learned the hard way why that's dangerous. The digital gold narrative failed. Bitcoin is supposed to be digital gold, safe haven, store of value, hedge against uncertainty. Here's the reality. During this crash, Bitcoin fell 45% from its all-time high. Gold rose 25% in the same period. Zoom out to the past year, Bitcoin down 40%, gold up 61%. That's not a small divergence. That's a narrative collapse. Bitcoin didn't protect investors during geopolitical tensions, didn't hedge inflation fears, didn't act as a safe haven during market stress. It behaved like a high beta tech stock, which is exactly what institutions treat it as. Does this mean Bitcoin can't reclaim that narrative? No. But right now, in this moment, that story isn't working. And markets trade on what's happening now, not what might happen eventually. So after all that chaos, where does Bitcoin actually stand right now? Let me show you the technical picture, because this is where price action meets probability. Support zones. These are the floors that matter. $69,100. Fibonacci 0.236 level. Bitcoin's holding just above this right now. If it breaks, we're not talking about a minor dip. We're talking about rapid downside acceleration. 66,900 to 70,600. Dense demand cluster according to Glassnode. We're inside this zone right now. Either buyers defend it with conviction, or we're testing 62,000 fast. 60,062. The crash low from February 5th, ultimate floor. If it breaks, we could see 55,000 or worse. That would signal structural breakdown, not just correction. Resistance zones. These are the ceilings that matter. 71,000. 24-hour high. Breaking this on volume would be the first genuine bullish sign we've had in weeks. 73,300, Fibonacci 0.382. First real resistance. If Bitcoin reclaims this level, it suggests the worst might be behind us. 80,200. The true market mean, according to Glassnode. Most critical level on the entire chart. Reclaiming it would signal a regime shift back to bullish conditions, where short-term fear turns into medium-term confidence. 94,500. Short-term holder cost basis, massive overhead supply. Most recent buyers are underwater here. They'll be looking to exit at break-even. Getting through this level takes sustained institutional buying. Here's what the technicals are telling us. If Bitcoin holds 69,100, we could see a bounce to 73,000, potentially higher. If it loses 69,100, we're testing 66,000. Then 62,000, potentially mid-50s. The technicals are fragile. Moving average is bearish. RSI recovering from oversold, but still neutral. And here's something critical. Volume patterns favor the bears. High volume on down days, low volume on up days. That's not the signature of healthy recovery, that's distribution. If this analysis is helping you see things more clearly, if you want to stay ahead of these moves as they develop, make sure you're subscribed. We'll be tracking these levels in real time. Now let's talk about whales, the big players who move markets when retail isn't watching. February 6th, the day right after the crash, something remarkable happened. 66,940 Bitcoin flowed into accumulation wallets. Single day. Largest single-day whale inflow since 2022. Over $4 billion at those prices moving into long-term holding addresses. Here's what else the data shows. Wallets holding between 10,000 and 100,000 Bitcoin added 70,000 BTC, roughly $4.6 billion, early February. Wallets holding between 1,000 and 100,000 BTC accumulated consistently throughout the crash. Glassnode's accumulation trend score hit 0.68, coordinated buying across multiple whale cohorts. But here's where we need to be careful. Not all whale accumulation signals are what they appear to be. Sometimes what looks like accumulation is actually exchanges reorganizing their internal wallets. Not new buying, just coins moving between custodians for operational reasons. CryptoQuant's head of research warned about this directly. So while the whale data is encouraging and suggests smart money is positioning for recovery, it's not a guarantee. It's a signal, not certainty. What about institutions? MicroStrategy, now rebranded as Strategy, bought another 1,142 Bitcoin in early February for $90 million. They now hold over 714,000 Bitcoin, worth roughly $49 billion at current prices. But here's the problem nobody's talking about. Their average purchase price is $76,000. Their entire holdings are currently underwater. They're not panicking. CEO Michael Saylor has made it clear they're long-term, but they're feeling pressure too. BlackRock's IBIT had one massive buy day, February 6th, but flows have been inconsistent since. Fidelity has seen consistent capital bleeding, and February 12th, every single ETF recorded outflows. Not one, not most. Every single one. Institutions aren't panicking, but they're not rushing back in either. They're cautious, waiting for confirmation. And that's what makes the next few days so critical. Let's zoom out and look at the economic backdrop driving all this. Because Bitcoin doesn't trade in a vacuum. It trades in the context of Federal Reserve policy, inflation data, tariffs, fiscal crises. And right now, that context is extraordinarily complex. Inflation. February 13th, U.S. reported January CPI at 2.4% year over year, down from 2.7% in December, better than expected. Core CPI came in at 2.5%, in line with forecasts. Lower inflation is good for Bitcoin, gives the Federal Reserve room to cut interest rates, provides liquidity, boosts risk assets. After that CPI print, odds of a June rate cut jumped to 83% according to CME FedWatch tool. But here's the catch. October CPI data was distorted by a 43-day government shutdown. Bureau of Labor Statistics couldn't collect data properly. They assumed no price increase for that month. Moody's estimates the real CPI would have been around 2.7% without that distortion. So the Fed might be operating on false confidence, thinking inflation's cooling faster than it actually is. If they cut rates based on artificially low numbers, inflation could resurge. That would force them to reverse course. Catastrophic for risk assets. Kevin Warsh and the Fed transition. Jerome Powell's term ends May 15th. Warsh takes over, but his Senate confirmation is not guaranteed. Senator Tillis is blocking the vote until a DOJ investigation into Powell is resolved. Democrats are aligned against Warsh because of his hawkish philosophy. The uncertainty is real. Markets hate uncertainty. Warsh has signaled a strange hybrid strategy. Cut interest rates to stimulate growth, but shrink the balance sheet to fight long-term inflation. Simultaneously hawkish and dovish. It's confusing, the yield curve. Nobody knows how this plays out. Not economists, not traders, not even Warsh himself until he's actually in the chair. Trump's tariff war with Europe escalated dramatically in mid-January. He threatened 10% tariffs on 8 European nations over Greenland disputes, then raised it to 25%. The EU is now preparing $107 billion in retaliatory measures. And here's where it gets legally interesting. The Supreme Court is reviewing whether Trump even has the authority to impose these tariffs under the International Emergency Economic Powers Act. A ruling against him could reverse $135 billion in duties overnight. If tariffs stay, inflation stays high. Fed can't cut rates. If they're rolled back, inflation drops. Bond yields fall. Bitcoin could rally hard. This Supreme Court decision, expected in April, is one of the biggest wildcards of the entire year. The U.S. fiscal crisis. Congressional Budget Office projects a $1.9 trillion deficit for fiscal 2026, nearly 6% of GDP. Public debt at 100% of GDP, climbing toward 120% by 2036. Annual interest payments on the debt are now $1 trillion, triple what they were in 2021. By 2036, 27% of all federal tax revenue will go just to paying interest, not defense, not infrastructure, interest. The debt ceiling was hit January 1st, 2025. Treasury is using extraordinary measures right now, but those run out sometime in summer or fall 2026. Here's where this connects to Bitcoin. If the US faces a genuine debt crisis or even a credible threat of default, the dollar's global credibility collapses, and that scenario brings Bitcoin's digital gold narrative roaring back, not as a tech play, as a genuine hedge against fiscal collapse. Let me remind you again, this is analysis, not financial advice. I'm laying out the data and the scenarios. Your decisions are your own. Always do your own research. Never invest more than you can afford to lose. So what should you be watching? What events? What data points? What decisions are going to move Bitcoin in the days and weeks ahead? Let me map this out clearly. This week, next 72 hours, Monday, February 16th, Washington's birthday, US markets closed, thin liquidity. Expect muted action, waiting period. Tuesday, February 17th, ETF flows, resume. First real institutional test since the holiday weekend. We also get US retail sales data and FOMC minutes from the January meeting. Those minutes show you what the Fed was thinking before the crash, whether their tone has shifted. Friday, February 20th, the PCE report, the Fed's preferred inflation metric. This data point moves rate expectations more than any other. If PCE comes in hot, rate cut expectations get pushed back. If it comes in cool, June cuts become more certain. Next 30 to 90 days. March 11th, February CPI data, first full post-tariff inflation print, absolutely critical for understanding where prices are headed and what the Fed can do. March 17th to 18th, FOMC meeting and rate decision. Currently a 26% chance of a rate cut at this meeting. Volatility will spike regardless of the decision. March 2026, Kevin Warsh's Senate confirmation hearings. Expect sustained volatility around this date. Markets will parse every word he says for clues about future policy. April 2026, the Supreme Court ruling on Trump's tariffs. Single biggest wildcard on the entire calendar. If tariffs are rolled back, Bitcoin could rally hard on declining inflation expectations. If they're upheld, inflation stays elevated. Fed stays tight. This decision has multi-month implications. May 15th. Jerome Powell's tenure officially ends. Warsh takes over as Fed chair. Policy shift begins in earnest. Rest of 2026. June 16th to 17th. FOMC meeting. Could be the first rate cut. If it happens, massive bullish catalyst for all risk assets including Bitcoin. Summer to fall. The debt ceiling X date, when Treasury's extraordinary measures run out. U.S. risks, default, potential crisis moment, extremely bullish for Bitcoin if it escalates, validates the fiscal collapse narrative. November 4th, U.S. midterm elections. Arizona has a Bitcoin reserve ballot measure on the ticket. Political landscape around crypto could shift significantly depending on these results. Each of these events is a potential inflection point. Not all will matter, but several will, and knowing what to watch puts you ahead of the crowd. Let's talk probabilities, 3 most likely scenarios for how this plays out, and what each one requires to happen. Scenario 1, recovery, 40% probability. What needs to happen? ETF flows turn consistently positive. Warsh signals a dovish surprise during confirmation. Tech stocks stabilize, AI bubble fear subsides. Supreme Court rolls back Trump's tariffs, eases inflation fears. The path? Bitcoin climbs from 69,000 to 73,000, breaks through 80,000 to reclaim the true market mean, pushes through 94,000 to clear short-term holder resistance, reaches 100,000 or higher by summer. This is the bullish case. Requires a lot to go right, but it's not unrealistic. Fundamentals are still intact. Infrastructure still growing. History shows extreme fear, like the Fear and Greed Index hitting 5 on February 6th, has often marked major bottoms. Timeline? 3 to 6 months if all conditions align properly. Scenario 2, extended consolidation, 35% probability. What needs to happen? Mixed signals, some ETF inflows, some outflows. Warsh's confirmation goes through, but his initial policy stance is neutral. Neither aggressively dovish nor hawkish. Macro data choppy. No clear catalyst emerges in either direction. The path? Bitcoin trades in a wide range between 60,000 and 80,000 for the next 3 to 6 months. Multiple tests of both extremes, sideways volatility, no clear trend until Q3 catalysts emerge, potentially debt ceiling crisis or midterm elections. This is what's happening right now, and honestly, this might be the most likely scenario. Markets don't always give you clean moves. Sometimes they just chop until clarity emerges. Scenario 3, further decline, 25% probability. What needs to happen? ETF outflows resume aggressively. Warsh is confirmed and immediately signals aggressive quantitative tightening. Tech stocks crash again as AI bubble fully bursts. Tariffs remain in place. Inflation resurges. The path? Bitcoin drops from 69,000 to 65,000, 62,000 breaks, then 55,000, potentially 50,000 or lower. In an extreme scenario, if multiple structural shocks hit simultaneously, some analysts see 40,000 as possible. But that would require a genuine market-wide crisis, not just Bitcoin-specific weakness. This is the bearish case. Lowest probability, but not impossible. And if you're managing risk properly, you should be thinking about what you do if this scenario unfolds. So where does all of this leave us? Bitcoin's at a crossroads. It's not broken. The fundamentals: network hash rate, long-term holder accumulation, institutional infrastructure, regulatory clarity, still intact and improving. But confidence is shaken. The digital gold narrative failed during the exact moment it was supposed to prove itself. Correlation with tech stocks is a liability, not an advantage. And the macro backdrop, Warsh, tariffs, debt ceiling, is filled with uncertainty. Here's what you need to remember. The crash was a perfect storm. Not one cause, but 5 hitting simultaneously. Warsh's nomination, ETF outflows creating a feedback loop, AI bubble starting to deflate, $2 billion in forced liquidations, and Bitcoin's failure to act as a safe haven when investors needed it most. Whales are accumulating, but not aggressively. Institutions are cautious. Retail has been liquidated and is largely sitting on the sidelines. The technical picture is fragile, but not broken. Holding 69,100 is critical. Breaking 80,200 would signal a regime shift back to bullish conditions. Until then, we're in no man's land. The macro environment is mixed, inflation is cooling, which is good. But Warsh's hawkish philosophy, Trump's tariff war, and the looming debt ceiling crisis are all wild cards that could move markets violently in either direction. Tuesday, February 17th is the first real test after this holiday weekend. Watch ETF flows carefully. Watch retail sales data. Watch how institutions respond when they come back online. And remember this: extreme fear has historically marked major bottoms. February 6th, fear and greed index hit 5. Extreme fear territory. Doesn't give you exact timing, but it tells you something about market structure. When everyone is terrified, that's often when the best opportunities emerge. Not immediately, but eventually. Whether Bitcoin bounces to 100,000 or falls to 50,000, the next few weeks will set the tone for the rest of 2026. And the decisions you make now, based on data, not emotion, will determine how you navigate what comes next. Stay informed. Watch the data. Don't let fear or greed drive your decisions. Because in markets like this, clarity is your greatest advantage. If this breakdown helped you see the bigger picture more clearly, if it gave you a framework for understanding what's actually happening right now, make sure you're subscribed, because the crypto market moves fast, the macro picture shifts daily, and the next catalyst, whether it's a surge in ETF inflows, a surprise from Warsh's confirmation hearings, or a Supreme Court ruling that changes everything, could happen overnight. You don't want to be caught off guard. Drop your thoughts in the comments. What scenario do you think is most likely? Are you watching the 69,000 support level as closely as I am? What questions do you have about any part of this analysis? I read every comment. The best discussions always happen in the community. If you're interested in collaborating or discussing this analysis further, whether you're building in the space, managing institutional capital, or just deeply engaged with these markets, feel free to reach out. This is a moment where informed voices matter more than ever. And one more time, because this is important, this is not financial advice. This is analysis. Your capital, your decisions, your responsibility. Always do your own research before taking any action. The next chapter of Bitcoin's story is being written right now. Let's watch it unfold together. Thanks for being here. I'll see you in the next one.